Let's discuss preference shares um, very quickly. We say that preference shares, first of all, characteristics. When it comes to preference shares, your mind, the word preference share. Okay. In UK language, we call it preference shares. In US language, we call it preferred stock. Why do we call it preference shares? Because number one, they have a fixed dividend attached. Unlike ordinary shares, in ordinary shares there is no commitment for a fixed dividend by the company. But in case of preference shares, there is a commitment of a fixed dividend. And number two, they have a priority. So when the profits are made, whenever we calculate our profits, first we pay that fixed dividend to the preference shareholders. And if something is left, and some profits are remaining, those can be, not must be, but those can be given to the ordinary shareholders. Why I'm saying those can be or may be given? Because there is no commitment. So I make a profit of $100,000. I have a preference dividend of 30,000. I must give them 30,000. First, I give them. What is remaining? 70. Out of the 70, I can give something to ordinary shareholders, or I might decide not to give anything. So preference shareholders, they have a priority, number one. Number two, in case of company goes into liquidation, business goes into bankruptcy or liquidation, the first we have to pay money, return back the money to the preference shareholders, and if something is left, then we can pay it to the ordinary shareholders. So these are the two priorities, major characteristics which we see in the preference shareholders. So, like ordinary share, preference shares have a face value like $1, $2, $10, whatever it is, which is known as nominal value. We learned it before. And preference shareholders have no voting right. So, this is very important to remember that preference shareholders, they have no voting right. Preference shareholders also receive dividends, but this is usually a fixed amount, 6.5%, 7%, 8%, whatever. Preference dividends are paid before ordinary dividend. Like I said, that first you settle the dividend or first you pay off the dividend to preference shareholders and then ordinary shareholders. So preference shareholders are standing in front of the queue. And in the event of liquidation, first you settle first you realize the preference shares, you give them back their money, whatever they have invested. Preference shares may have conditions attached to them. So this is very important. If you see that this is what is a preference share, it looks like. So a preference share is actually, number one, that it has this thing which says a dividend, which is 8.75% return. So that's a fixed commitment with them. And then preference shares could be redeemable or irredeemable. So remember, there are two types of preference shares. We call them redeemable preference shares and irredeemable preference shares. Now, redeemable preference share, and this is very important to understand because it will have some important implications. Okay. Um, Redeemable preference shares, which means that when we issue the shares, uh, we said that it is a preference share which gives you 8.75% return and it has a life of 5 years, which means that ordinary shares, they don't have a life. Ordinary shareholders cannot come back and say, I'm returning you the shares, give me back my money. No return in ordinary shares. In preference shares, if it is redeemable, after 5 years, they can come back and they can claim their investment. So we call it redeemable. Irredeemable means just like ordinary shareholder. Irredeemable means I'm giving you the shares, but you cannot return me back. Okay. So redeem, the word redeem means to convert to cash. Redeem means to convert to cash. So it means that redeemable ordinary shares can be converted to cash, which means that the preference shareholders can come to me and say, give me my money back. Now, remember, a redeemable preference share, it looks like a debt. A redeemable preference share, it looks like a debt because debt had two conditions. Number one, a fixed interest rate, and number two, a fixed life. When I went to the bank says, give me 10% return, and I'm giving you the loan for 3 years. After 3 years, you have to return me back the money. So these were the two conditions of the debt which the bank asked me. If I'm issuing redeemable preference shares, essentially I'm agreeing to the both conditions. Number one, I will give you 8.75% return, and number two, I will return back the money in 5 years. So it means that the redeemable preference share is not equity. The redeemable preference share will be shown in the balance sheet as debt. Okay, remember the redeemable. So when you say equity, because this will be a question always, that where do we show preference shares, equity or debt? Answer is redeemable preference share. It goes as debt, as a liability, because you have agreed to pay a fixed interest and you have agreed to pay back the fixed amount. So whenever you agree to pay someone a fixed amount, you are actually taking a liability. So preference, redeemable are liability. The second concept is cumulative and non-cumulative. Cumulative means that, and this is about this interest, okay? Cumulative is about the interest, which means that we agree with you that we will pay you 8.75% dividend, which is called preference dividend, which actually looks like interest, but we call it preference dividend. So 8.75% is the commitment. In some year, for some reason, if we do not have sufficient profits to pay 8.75%, next year we will pay you both the next year dividend plus the last year dividend. So any unpaid dividends are accumulated. That is actually a very dangerous condition. This year I don't make profit, so I say I'm not paying you 8.75%. I don't have profits. So next year you will come in and you will say, now you pay me twice. The last year which you did not give, and this year as well. This is called cumulative. Non-cumulative means that if for this year funds are not available, we will not give you. Next year, when funds will be available, we will give you 8.75%, but we will not give you the last year's because it is non-cumulative. Now, the cumulative preference share again is a debt because it is assuming a liability. If I don't give you now, I will give you tomorrow. It's a liability, it's a commitment, it's an obligation. Whereas in non-cumulative, it's not a liability because it says, if I have funds, I will give you 8.75. If I don't have funds, you will just forget it. So remember that two types of preference shares, they go as a liability. One, because this will be presentation of financial statement. If you have redeemable preference shares, that is as a liability and it is treated as a debt, and the cumulative preference shares, they are also the debt instrument. Okay. So this is important because sometimes when you are calculating some kind of ratios, debt to equity ratios, you need to know in the balance sheet how much is equity, how much is debt, and then suddenly you see, oh, that's a $10 million preference share. Should I take this 10 million in equity or in debt, because I have to calculate the ratios? So you need to understand this point. Okay, what else about preference shares? Other possible conditions. Yeah, this is a very rare condition because generally we said that preference shares, they do not have the voting right. But sometimes you do have participating preference shares. Participating preference shares that although they will receive dividend as preference share, a fixed amount, but we also give them some participating right, which means they can, they can participate in the voting process. Okay, then you have convertible preference shares. Convertible preference share means that they can be converted into equity shares at some point. Okay, so if I have a 5 years redeemable preference share, I could have 5 years convertible preference shares. Because remember that businesses who are doing really good, I tell you, if my business is doing really good, and if I know that I can take money, invest in my business, and I can make 20% profit, I would always go for a preference share. Why? Because preference share, I will give 8% or 9%, and plus they will never become the owner of the business. And if it is redeemable, after 5 years, I will pay back their money and say them goodbye. And the business, very profit making business, becomes my business. They don't have a right on that. So usually businesses who are successful, they are actually not very happy to issue the ordinary shares. A lot of times they are offering the preference shares. So you come to me and you say, I want to invest in your business $100,000. I say, yeah, I'm offering you preference shares. You are also very clever. And you say, oh, you want to use my 100,000 in your business, give me 8%, and then when your problems are solved, you will say me goodbye. So I don't want to get preference shares. Give me equity shares. And I say, no, I cannot give you equity shares now. Yes, what I can do, I can give you a convertible preference shares, which mean for the first 5 years, it will remain as preference. And after, at the end of 5 years, probably if you want, you can convert it into equity. So this is called convertible equity shares, convertible preference shares. Presentation, I have explained you that what goes as a liability. There are two types of preference shares which are shown as a liability, because conceptual framework says that when you have an obligation to pay out. Okay, so when do I have an obligation? I have an obligation in case of when I have cumulative irredeemable preference shares or redeemable preference shares. So two types of preference shares, they become part of debt or liability. One, redeemable preference shares, and two, cumulative irredeemable preference shares. So they become part of the debt. Then finally, we have non-cumulative irredeemable preference shares. So non-cumulative irredeemable preference shares, they are equity. Why? Because number one, they are non-cumulative, which means I don't have a liability to pay interest. If this year I don't pay, next year I'm not going to add it up. And number two, they are irredeemable. So there is no obligation to pay. Irredeemable means actual investment will not be returned back. And number two, as far as the dividends are concerned, they are also non-cumulative. So they are treated as equity. When you talk about redeemable preference shares, cumulative, irredeemable. So irredeemable means that I'm not promising to return back the actual money. So that looks like equity, where I'm not promising to pay back actual money, but I'm actually taking a liability of paying you the dividends. If I don't pay this year, I will pay you next year. So because I'm taking a liability to pay here, so that's why this is debt. Okay. So cumulative redeemable, irredeemable. Cumulative irredeemable is part of debt, and non-cumulative irredeemable. Irredeemable means no guarantee for returning back the money, and non-cumulative means no guarantee for accumulating the dividends for the next periods. Then we say, what are the advantages from the point of view of the company? Preference shareholders do not have the voting rights. The cost to the company share is typically cheaper than the cost of ordinary shares. Yes, again, the concept of higher the risk, higher the return, lower the risk, lower the return. So what we say, the cost is less, because remember that preference shareholders, they have a return, they have a right to a fixed dividend. So it means that they are not actually taking much risk. Equity shareholders, always remember, equity shareholders, these are the people who are taking the maximum risk in the business. Maximum risk. Because when you are equity share, or when you are the owner of equity share, you agree on two conditions. Number one, whatever dividend you will give me, I will say you thank you. You give me more, you give me less, it's your choice. Number one condition. And number two condition, I'm giving you my money, but I will never come back and ask you to return back my money. It's a huge risk. So therefore, equity shareholders, they expect more return. So the cost of preference shareholders is generally less than the equity shareholder, but more than the bank. Where a company is not permitted to obtain additional debt finance. Now, that is another condition. Sometimes what happens, that if a business has taken a lot of loans and on the balance sheet, they have already taken some debts. So the debt providers, like your bank, they put some covenant. Covenant means conditions. Different type of covenants they can put. One of the covenant is that you cannot take additional debt until you pay my previous debt. This is one condition. You go to a bank and say, I need $5 million loan. Bank says, okay, I'll give you 5 million, but on this condition that you will not go and take from someone else unless you pay back my money. So if such a covenant is there and a business still needs some money, what do? They will issue the preference shares. This is one of the advantages, because because they are not allowed to go to another bank, they do want to take some loan, they do want to take some debt, but not from the bank, but in form of preference shares. So that is kind of a, you can say, a loophole or maybe a way out to solve that issue, to avoid breaking the covenant. Disadvantage: payment of preference dividend is mandatory. You have to pay 8.75% where sufficient distributed reserves are available. If there are reserves on the balance sheet, you cannot say I'm not paying. Equity shareholders, you can say that, see, this is 1 million, but I'm not giving you because I need it for myself. I'm going to start a new project. But for the preference shareholders, you cannot say this is 1 million and I'm not giving you. If you have the money, you have to pay it. And number two, the cost of preference shares, it is cheaper than the ordinary shares, but it is expensive from the as compared to debt. So bank still is cheaper. So you can say that ordinary shares most expensive, bank is the cheapest. In between is the preference shares. And then preference dividends, unlike interest, are not tax deductible, and actually, again, you have, if you have a cumulative preference dividend, you have it goes as your finance cost as interest expense into your before tax expenses. That goes into the profit and loss account. So when you calculate your net income for the purpose of, net income available to for distribution to ordinary shareholders, at that time you deduct your preference dividend. But when you calculate your taxable income, you cannot deduct. So we say that this is also one of the disadvantages. Like if I pay interest to a bank, I can show it as my expense in the income statement. So I pay interest like 9% to a bank. That is a fixed amount, and I call it interest and I take it in my income statement as my expense, and my profit goes down. But if I pay a preference dividend of 9%, that I cannot claim as an expense in my profit and loss account, and that is not going to reduce my taxable profit. So this is one of the disadvantages, that although you are paying a fixed amount, but it is not tax deductible and it does not decreases your taxable profit. So you still have to pay more uh, tax on your profit. So this is one of the disadvantages.